Let's welcome in Gautam Chhaochharia, Head of India Research, UBS Securities. He now joins us on a phone line. Gautam, thank you so much for taking out time for us. What do you think is keeping the market so subdued in the last 7 days? Is it just lack of volumes, or do you think that there is a lot of redemption pressures from FIIs?
There's a quiet period, and what we are seeing in India is nothing different versus what we are seeing in other emerging markets also. So it's not India-specific necessarily, and it's not at year-end we see redemptions of sell-off by FIIs in general. So this is more what's happening to the emerging markets per se, rather than India-specific in our view.
Right. What is the sense that you get from FIIs? Everybody just wants to own developed markets now rather than emerging markets. Is that the trade which is changing?
It has been happening, and it's a natural reaction for investors after the rally which emerging markets saw, and some hopes building up around U.S. growth next year post the new presidential election. So is this a beginning of a longer-term trend? We would believe not, because in the longer term, if U.S. growth comes back, it also helps emerging market growth complex directly and indirectly. So in the longer term, not really. But in the near term, this trend has been playing out, could play out for a while, difficult to say. But not necessarily a fundamental trend building up.
Do you think that investors are just waiting for the new president of US? What is the sort of policies that are announced over there? Will that mean emerging markets would have to cut more tax rate, will have to give more SOPs? Because likely to see a much more expansionary sort of a policy into US now.
So it's possible. Again, investors are obviously not just waiting, but are already building in a lot of hopes around the new presidential policy taking in the US in terms of fiscal expansion, etc. So while the contours or the specifics of that policy expansion is still very unclear, because we know that only when we see output of that in the statements post him taking over as president next year. And you have to remember that the impact of any such expansionary policy is very different depending on what you take. So if you cut tax rates, the impact is felt far more immediately in the short term in terms of consumption, etc. But if you are looking at reviving an infrastructure capex cycle, that typically takes longer, because it's not something which you turn on in a day. That entire process has physical limitations.
Right. In terms of, when you talk to your FII clients and try to find out, what they are looking at in terms of buying, or, what would they be interested in, what is the sort of questions that you get? Are they in a very tricky situation right now, and that's why just being on sidelines?
So it's anyway year-end period, so it's a lot more quieter now. But we are not seeing any material positioning changes. If you look at the market moves, I won't classify the market moves as anything sharp as such. Even with the emerging markets, India, then okay, it's not really end up performing in a meaningful way recently. The big thing for India, obviously, investors' mind is what happens to demonetization impact beyond the first 2-3 months, and what the policy response by the government would be in late January, early February. So those are things which investors are watching out for, but I don't sense the broader investor community is trying to position ahead of it in any meaningful way.
Right. With such market falls, as a strategist, how would you look at valuations right now? You think valuations are attractive if somebody is looking at FY 18 or 19 numbers, or it's still just too early to call that, this is attractive or not?
So our fair value for December 16 was 8,000. And that was based on earnings estimates prior to impact of demonetization. So in that context, I don't think the market is attractively valued for investors looking at a shorter term horizon of say 6 months or even 12 months. It's just about trading at fair value, possibly slightly more than fair value if you build in demonetization impact. And the markets are not pricing in any impact of demonetization if it lasts for more than 3 months. So if the demonetization impact lasts for 6 months, 12 months, then obviously the earnings cuts will be much more severe, and markets might be richly valued here. So I won't say it's attractively valued in absolute terms, but yes, the correction does make it appear attractive versus where it was 6 months back. The longer-term story, we would still argue, remains intact for India. And in that context, for investors looking at investing from a longer-term perspective, the valuations now at least are not as rich as they were a few months back.
Right. What do you do with the overall FY18 estimates? Very, very difficult to, cut them now. I was just looking at Bloomberg estimates. It's, still about 15-16% sort of growth that Street is estimating. That's still very, very optimistic, even if we assume that Q3 and Q4 become very muted.
So there are two things there. One is the Y&Y growth number in itself, and second is the absolute earnings number, because from whatever I have seen, and have not even cut FY17 numbers yet. One, to reflect the real economic growth trajectory prior to demonetization, which in our view was overly optimistic, and the impact of demonetization also. So on a base of actual FY17 numbers, which will be much lower than where it is now, then achieving a 14-15% growth rate in FY18 is definitely possible, because second half will have a very, very good base. But the absolute EPS numbers are way too high, because the FY17 number itself is not being cut.
Right. In terms of, what would you do for, say, if you're a one-year investor, what will be your advice to your investors? Is it still very early to go ahead and invest, or just wait for Q3 numbers, Q4 numbers, then probably make a strategy?
So risk reward seems to be balanced. And therefore, it's not an obvious answer is not to go and buy at these levels. So investors could get better opportunities ahead over the next 3 to 4 months. But it's not even a level where you don't want to stay invested or sell off. So it's kind of a evenly skewed risk reward at these levels.
Say if, in the month of Jan, there are a lot of unknowns that are there. Do you think markets will be very volatile in the month of Jan? It will be very confusing to, try and predict what the flows will be, because we'll get the corporate numbers. Probably a lot of announcements should come in from the government. US will see their president change and maybe a few policies being announced. And then on the first day of Feb, we see the budget coming in. So do you think there are a lot of events in the month of Jan, and that's why one has to be very careful?
So I don't think the markets will react too much to December or Jan numbers in terms of high frequency data, monthly sales, or even quarterly numbers. I don't think markets will worry too much. What markets will worry or will drive future direction will be, in our view, two principal elements. One is obviously what happens in the US if we start getting sense of the policy clarity. And secondly, India specifically, the policy response, if any, to demonetization. So whether we actually see an expansionary budget on 1st Feb, or we see a stimulative RBI in 1st week of Feb, that would be critical elements for the market.
What sectors would you be overweight on, in such an uncertain environment? Say, what is looking very, very attractive now?
So we still remain overweight consumer staples, we remain overweight pharmaceuticals, we remain overweight private retail-focused banks, even non-bank financials selectively. But it's a lot more a market where you have to be stock-specific rather than just which sector-specific.
Right. When we last spoke just after demonetization, you were not so sure about consumer durable, what valuations they would be, what sort of cuts they would see. They have seen further derating, but still, what is the earnings trajectory is slightly difficult to predict in the short term?
So I think the correction we have seen is not really material derating, because earnings have seen such a cut. And the correction we are seeing are from levels which are very, very high, very, very rich a few months back. So in absolute terms, I don't see as a broader sector consumer discretionary is attractive yet. Obviously, the long-term story still is very good. But obviously, there are pockets and stocks where the fall has been a lot more, and where the implication of a severe impact because of demonetization might be far-fetched. So stock-specific opportunities are emerging. Sectors overall, not really.
Right. And just a word on the pharma pack. You mentioned that you would be overweight. Say if US was to grow, you think that's one sector that will benefit, and after the recent correction, the sector valuations are not as high as it was about 12 months back?
Exactly. So absolute terms also now valuations are getting into reasonable zone. It's not cheap yet, but at least in absolute terms it's reasonable, and definitely very, very cheap compared to what it was a year back. And a lot of the concerns around FDA and pricing pressure in the US might also be gradually getting priced in, because we have seen earnings estimates being cut in the sector sharply. So the risk reward wise might be a good, but again you have to be very, very stock specific there, because as always it is in that sector specifically, because different companies have different pipelines, and you shouldn't get into the same rush.
Gautam, most of the strategists that we talk to are overweight on IT. You, of course, were quite underweight on IT since a while. Would you want to change that call, or would you be looking at IT stocks now? Because they've corrected quite a bit, but on the other hand, even dollar index is going up, so they get a currency headwind as well, currency tailwind as well.
We still haven't changed our underweight call on IT, and our concerns were largely long-term structural concerns for the industry, which is now becoming more commonly accepted among the IT analyst community out there. From a strategy perspective, yes, practically, if you look at the market correcting in absolute terms, then IT might be an outperformer. But it has to be a really bearish call on the market to really be overweight IT services. So at this stage, I won't just change IT rating based on a currency view. So we have to see more evidence of U.S. recovery, cyclical recovery in higher tech spending. If you start seeing signs of that, or analysis suggests that happening, then we might look at it.
Gautam, thank you so much for taking out time for us.